You wear a helmet not because you expect to fall, but because you want to stay protected in case you fall. Your long-term stocks portfolio also deserves the same protection, and that's exactly what options can do via hedging. Hi, I am Pranav VK, your options trading guide here at Stockshala by Kotak Securities. Many investors hold stocks of Reliance, TCS and other blue chip stocks for a very long period of time. But the stock markets are unpredictable. And that is exactly why we have to use risk management techniques to reduce our losses when the market turns downside. When market turns extremely volatile, a hedge helps us reduce the temporary damage. Hedging isn't about avoiding the loss completely, but when things go wrong, it will help us in limiting the losses. In this video, we'll discuss two different types of hedging. One is a protective put and the second one is a covered call. So let's start with the protective put. So what does it entail? Let's understand with an example. Here in this case, assume that you hold one lot of TCS at rupees 3,800. So what you're going to do is you're going to buy 3,800 put option at a premium of rupees 100. And let's say if TCS falls from 3,800 all the way down to 3,600, that's a 200 rupees fall in the entire stock. So for every share that you hold, you're losing rupees 200. But since you have bought the protective put, that is 3,800 put option at rupees 100, this will increase by rupees 200. Which means the stock is falling by 200, but your premium is increasing by 200. So what will be my net loss? 200 rupees gain in my premium, 200 rupees loss in my actual stock, and finally the 100 rupees that we have paid for buying this put. So instead of losing the actual 200 rupees, in this case, we are losing only 100 rupees. Let me give you an analogy to help you understand this concept better. Think of the stock as your house. And think of this put option as fire insurance. If there is no fire, then you are going to just lose the premium that you have paid. But in case there is a fire accident, then you are protected. So in simple terms, just because you had a fire accident, you're not going to sell the entire house, but rather you're going to protect it. Just like how a protective put is like insurance for stockholders, similarly, a covered call is going to help generate consistent income for the stockholders. Let's understand with an example. Imagine you own one lot of Reliance at rupees 2,500 and you sell a 2,600 call option at rupees 40. So in this case, since you're selling the option, you're receiving the premium of rupees 40. And assume that Reliance stays below 2,600 or expires at 2,600 rupees. So in that case, the premium is going to become worthless, which means rupees 40 is your income every single expiry. It is very analogous to renting out your property to somebody else so that you can get consistent income while you still own the asset. Now that we have understood a protective put as well as a covered call, let's compare both of them to understand it better. To start with, we are comparing based on the strategy, whether if you have to own the stock or not, the market view or your primary intent, as well as the goal. So looking at a protective put, as well as a covered call, in both these cases, it is mandatory for you to own the stock so that you can execute these specific strategies. When it comes to the market view, in protective put, we are looking at the primary intent, right? So the primary intent is that the stock is going to go up, but only in case it starts going down, then you want protection. So that is why you're buying a put option with a downside risk, right? So in case the stock falls, then in that case, you're going to make a break even or reducing your losses. And the goal in this case is only protection. But when the other side, when it comes to covered call, you're still owning the stock, but your view is, primary intent is that the stock is going to be sideways or mildly bullish. And that is why you're going to sell the call option which is higher than what the spot price is. And in this case, the goal is for generating income. In the covered call, you are selling the call option, so you're actually receiving the premium, but on the protective put side, you are buying a put option, so you're actually paying the premium. So these are the major differences between a protective put as well as a covered call. Let me give you a small test to understand if you have understood the concept better. Imagine you own Reliance 100 shares and there is results that is upcoming and you expect the market to be extremely volatile. So what do you do in this case? Do you go for a protective put or do you go for a covered call? Let me know in the comments below. So let's analyze this specific question and come to a conclusion of what we are supposed to do. So since you're expecting the market to be volatile because of an event or results, the idea is you want to protect your stock portfolio, which means it is very clearly a protective put that you are supposed to execute and not a covered call, because the primary intent is protection and not generating income. So when you are going for a protective put, you have to buy an at the money put option or slightly out of the money put option. But whereas when you're going for a covered call in case of generating income, you have to go for out of the money call option. The best part about these strategies is that you can always combine them along with your long-term wealth creation. So let's summarize what we have learned so far. We understood that if you hold a stock portfolio, then hedging is the key for limiting your losses and not entirely avoiding the losses. We learned two different types. The first one is a protective put, where it acts like an insurance, and the second one is a covered call where you can generate consistent income. We also identified the differences between a protective put as well as a covered call, and majorly we also looked at a real life example of how you can implement in the live markets. So you have to remember that you don't need to be a full-time trader to do this, but rather you can learn these strategies and execute even if you're not a full-time trader. In the next video, we are going to flip the script and show you how to create stock-like positions using just options. You will learn how to create long and short positions, which professionals and institutions use every single day. You're watching Stockshala by Kotak Securities. I am Pranav VK, and let me know in the comments below if you prefer generating a passive income or protection.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.